Hey traders, and welcome to our first video. In this video, you're going to learn when and how to use Fibonacci levels, which levels are actually important and why, how to enter and exit trades using Fibonacci retracements and projections, main mistakes that you should avoid at all costs when drawing Fibonacci levels on your charts. Let's get started. So when you should use Fibonacci retracements? In order to know the answer to this question, we must understand the three different Forex market cycles. Let's take a look. So in the downtrend, the market is making lower lows and lower highs. The market is also making impulsive and retracement moves. Because this is a downtrend, we want to be at the right side of the impulsivity and catch the trades at the end of the retracement move. As we can see, we could enter a sell position right after the retracement is over and run the trade to the downside. In an uptrend, the market is making higher highs and higher low. The market is also making impulsive and retracement move, the same as in a downtrend, just in the opposite direction. So if we want to be on the right side of the impulsivity, we want to take the trades at the end of the retracements to run the trade to the upside. So this is first scenario and this is the second scenario. That's how you can capitalize on retracements in an uptrend. So lastly, we have the consolidation phase. There is no direction, there's indecision in the markets. We are waiting for a breakout of this box to either side. Interesting fact, market is in consolidation phase 60 to 70% of the time. So in conclusion, as we can see, we can take the trades in a downtrend because of the strong impulsivity, and we can take advantage at the end of the retracements. In an uptrend is the same thing, just in the opposite direction. We can take the trades at the end of the retracements to potentially run the trade to the upside. In consolidation, there is no trades for us. We just wait for a breakout and the trend to form. So how to use Fibonacci retracements in combination with Japanese candlesticks? Firstly, let's take a look at the uptrend. So firstly, we need to identify the impulsive move. After some bearish candlestick formation, we can anticipate our retracements. In order to trap the price with Fibonacci levels, we need to identify the swing low and the swing high. Once we connect it from the swing low to the swing high, our Fibonacci trap is set. We need to wait and see if price will come to our levels. After some waiting, we see the retracement is potentially over. We can see some weak rejections which confirm the bounce from the 61.8%, which acts like a support. After the bullish engulfing pattern is formed, we can use this as an entry confirmation. Potential entry after the candlestick closure and our stop loss could be below the 78.6 retracements. For the take profit targets, we can use the minus 27.2 and the minus 61.8 projections. So now let's take a look at the downtrend. Firstly, we need to identify the impulsive move. After the impulsive move is over, we see some bullish candlesticks in the opposite direction. Now we need to identify the swing high and the swing low points to draw our Fibonacci retracement. As we can see, price is not at any of the important levels. After some waiting, we can see the retracement is potentially over and we get a nice weak rejection at the 78.6 level. With evening star candlestick pattern formation, which could confirm our trade. We cannot enter the trade before the candlestick closure. A potential stop loss could be above the 88.6% retracement because we entered the trade on the 78.6. After some waiting, we could use our Fibonacci projections minus 27.2 and minus 61.8% as our potential take profit or exit targets.
What's going on, guys? It's Mike back with another video, and what you guys just heard is the simplest Fibonacci breakdown. This is what I always talk about in my videos, especially when you guys are trading these funding firm accounts, bro. This is so simple because with these trading firm accounts, you're going to be able to use this strategy to incorporate it with their high capital, and I'm going to explain to you guys what I mean. We're gonna hop in the charts in a few minutes here, but if you guys have not gotten a challenge account, man, don't trade with $50 or $100 no more, bro. I wouldn't even say do it. Just go ahead and take advantage of what we have access to in this year, man. And it is these prop firm accounts, man. Like always, I'm going to leave the link in the description for you guys. Also leave my discount code in there so you guys will get 5% off of when you guys get a Trading Challenge account. So man, like take advantage of that. But let's go ahead and hop in these charts, and I'm going to show you guys why trading with big capital is so important. Okay, so let's hop in the charts real quick. All right, guys, so I'm going to show you why it's so important to trade with a bigger account, man. I always talk about, get a challenge account, get a challenge account, get a challenge account in all of my videos, but I'm going to show you guys the reason why. Okay, so that little example that you guys actually just saw with that trader Stoic, Trader Stoic. I like to call him Trader Stoic, but Trading Stoic. He's a great day trader. A lot of his videos and stuff. Well, he only has like 1 or 2 on his actual channel, but his IG is very good as well. But we all know that it doesn't always come out as perfect as that. Like the candlesticks don't come out that perfect. Sometimes you have one long big candlestick, and it's like if you enter after that candlestick, then your stop loss is going to be so wide. And maybe you have a couple of candles that have just closed weird, and the candlestick pattern looks weird. So you're kind of like uneasy. You're like, well, I mean, maybe that is it. I'll get in anyways. I feel like it'll still go up, or different instances like that. So I'm gonna pretty much break it down on my video the best way possible for you guys. And guys, anything that I put in my videos is something that I've already tried for myself. And judging from my mistakes and the stuff that's happened to me, I try and help you guys not make the same mistakes, okay? Fair? Very, very simple. So, right here, this is a simple uptrend on UJ, and we're going to go down here. I want to show you guys how powerful this is because just like Stoic said, you want to wait for price to retrace to any of your, PR levels, like he was talking about, whether it's 38.2, whether it's 61.8, 78.6, 88, all of those areas. But the most important thing is understanding how far the pullback is going to be. Okay, that's really where the measurement is when you're using Fibonacci, because sometimes you'll have minor pullbacks, sometimes you'll have medium pullbacks, and sometimes you'll have those deep pullbacks. The deep ones are very, very beneficial because that's when price gets to the 78, 88, and then your stop loss is not going to be that big to where you have to risk so much on the account to where you're not really making that much. Okay, so I'm gonna show you guys what I mean. So right here, this is a higher low. So with Fibonacci, we're always trying to find our point A. So we got point A right here. Okay, I'm gonna make this very, very simple. Point A. Okay. Then we got our point B. And then we have our point C right here. Our 3 points, and with the Fibonacci, I'm going to grab the tool right here, and it's going to go from this bullish wick to this bullish wick right here. Okay? Very, very simple. So just like the gentleman said in the video, you want to wait for price to get to one of your PR levels. Okay? So the 23.6 is where price basically stopped at in this example, and this is what you want to consider. This is not necessarily saying you can't get in on a 23.6. Remember, Stoic said in the video that our take profits will be -27 and -61.8. Okay, so if you got in based upon this level right here after the close of this 4-hour candle, so we had a nice bullish variation to establish this area of price. So you would get in on the second candle, and just like Stoic said, you will put your stop loss behind the next Fibonacci level, and then our take profits are up here. So you can kind of see what happens right here. You see how we have a 82 pip stop loss and a 207 pip take profit. Okay, we got TP1 at -27 and then TP2 at -61.8. It's a pretty good risk, right? But you want to consider too at the same time that even though you're up here, price could still have a potential of retracing back to these areas. Okay, price could come back 238.2 to the I'm not going to include the 50. I'm just going to go to 61.8, 78.6, 88.6, and so on. Okay, so this is what you want to consider. But mind you, until this area right here is broken, this whole area right here, until this area is broken, the buy is still being maintained. Okay, that is that is the simplest way I can put it. Okay, because remember, with price, you have that higher high, and I'm gonna do it for you guys. You got that higher high, higher low, higher high, higher low, and so on. So mainly this is what we're looking at 24/7. Okay, so when price makes that first higher low, okay, once price makes that first higher low, then until this higher low is broken, the sequence continues. And then the same for this one too. Until this one, once this one is created, until this one is broken, the sequence continues. Okay? And just from this example too, like if you draw a fib from here to here, okay, like so, this is an example of what you're basically looking for. Okay? So the deeper you go, the better your take profits are going to be. Okay? So mind you, technically, these Fibonacci levels, if you're placing your stop loss behind the next Fibonacci level, technically you're still in this zone. Okay, you're still in this fluctuation zone. Okay, this is the whole zone. You're in this whole fluctuation zone. If you do that, it's entirely up to you, because remember what I just said, until this point is broken, the buy is still valid. Okay, so that's why most people will say, instead of placing your stop loss behind the next fib level, just to be safe, you want to place your stop loss behind the 100%, 120% max. Okay, that's why I have the 110% and 120% in red, because this is technically my stop loss levels. Okay, this is what makes it valid. That's why people say it's risky to get in at the 23.6, 38.2 levels, because you're so high within that fluctuation range. There's a higher chance of price pulling back on you. Now, it really just depends. So the way I like to think about it is like, if you can still keep your risk intact, so you could risk 0.5% on each level that interests you, or maybe you're that person that can be even more patient and you can wait for that medium pullback. Now, the medium pullback to me is like the 61.8 area, basically 61.8 area. The deep pullback for me would be the 78, 88 areas. Okay, so if you're in the medium to deep range, then you got a good risk, because if this ended up winding down here to the 61.8, you see the difference. 133 pip stop loss for 332 take profit. Very, very simple. Or even if you wanted to even get even more cheaper or more risky, my bad, then you could go to that next Fibonacci level. Now you have a 64 pip stop loss and a 332 take profit. So it's really going to determine how you guys are going to take advantage of the move. Okay, and mind you, this is just on the H4 time frame. So every single time one of these 4-hour candle closes, a new one is opening. To establish a position, it takes a bearish candle and a bullish candle. It takes two candles, especially in this uptrend example, to establish this area as a new higher low point or as a new support. So it took a bearish candle for this one close, and then it took a bullish candle for this one to close, and then we had our next candle. So that established the area. If you don't believe me, go up here and click the line chart and you can see how it is. Because as soon as that bullish candle closed, we got this little variation right here, this little point on the line chart. and that's what basically established that position. Okay, so mind you guys, take advantage of this when you guys are trading. If you would have tried to get in on the lower time frames, which is completely possible if you want to get on the lower time frames, and while the 4-hour candle would be bearish, because if you're getting in on the lower time frames like 30, 15, 5, that 4-hour candle would have still been bearish before you decided to get into the market. But if you're that person that just doesn't care, you just rather price just hit the Fibonacci range or area and then just get in, or even if it was just around this area and you just got in based on the 5-minute or 15 immediately and then place your stop loss behind there, it's totally okay. It's really up to you. So I would just consider this when you guys are trading these accounts. And the reason why I even mentioned the prop firm account in the very beginning is because a 60 pip stop loss or 100 pip plus stop loss on a smaller account, $50, $100, $200, especially with a point or a dollar lot size of 0.1 or a 0.01, you're really not making that. Well, 0.10, you're making okay money for the small account balance, but you're still risking a lot based upon that small account balance. Okay, so but with the 0.01s is basically if you're really trying to be careful and slowly building up that account, but you're only seeing chump change. But with a bigger account, man, it's going to be very helpful for you. You're going to be seeing decent profits, especially 332 pips or 100 pips or 200 pips or 50 pips. Like, you're going to see thousands of dollars within a small amount of moves. Especially 20-30 pips can pay out big with these trading firm accounts. So definitely consider this, guys, when you're trading. That I definitely wanted you guys to watch it. I thought that video was very informational, and I wanted to incorporate that on my channel. Shout out to that guy who explained it, Stoic. But other than that, guys, man, get you a funded account. Use that discount code, get you 5% off. I'm looking out for you guys. But other than that, like always, I will see you guys in the next video. Peace.